Welcome to our Cindy Bishop Worldwide Real Estate Training webinar today, where what we do is we focus on efforts to help real estate professionals know and grow. I'm Dave Redebaugh. I'm an instructor with Cindy Bishop Worldwide, one of the hosts of these webinars, and our intent with these is to create opportunities for our audience of real estate professionals to sharpen their skills and the knowledge of all things real estate. So that's why I'm excited to have Jim Perkins with us today. He's the branch manager with SWBC Mortgage in Vienna, Virginia, and a mortgage expert who has over 30 years in the business and is well respected not only for his experience and his knowledge, but also for his giftedness as a trainer. We're privileged to have him with us today as he unpacks kind of the intricacies of a very valuable program that's offered for first-time home buyers in the state of Virginia through the Virginia Housing Development Authority, the VHDA. So as a Virginia State certified trainer, Jim teaches classes to real estate agents and mortgage bankers on a list of topics related to financing real estate transactions that's exhaustive. So he knows the topic, he knows what he's talking about, he's an expert in this stuff. So more than that, I've worked with Jim on a number of different training projects, and I can tell you that it's hard to find someone who is as detail-oriented, as organized, as knowledgeable, and as thorough as Jim is. And on top of that, he's a genuine, thoughtful person who cares for people. Such a nice combination of personality traits. So before I turn this over to you, Jim, two quick reminders for our audience. Number one, geniuses take notes, so get your pen and paper ready. And number two, friends share. You will likely know others who can benefit from this information. So if you've joined us by video, like us, comment, share this with the friends of those that you've thought of that might benefit from this. So with no more delay, welcome, Jim. Let me turn this over to you.
Thanks, Dave, so much. And thank you, everybody, for tuning in. Basically, today, what we want to do is talk about some of the courses that Cindy Bishop offers. Specifically, we're going to be talking about VHDA. But first, a little bit of information about me, Jim Perkins, the SWBC Mortgage, the branch manager here. And today we're going to talk about the VHDA and some of the new programs they have. Some of the new programs for first-time home buyers and with no money down. So on our first slide here, let me tell you a little bit about VHDA, how they got started, and what their mission is: to provide an alternative to affordable financing from standard financing. So basically, it's designed for first-time home buyers, and VHDA stands for Virginia Housing Development Authority, and they're just trying to provide an alternative to banks and other different types of financing that might be out there that's going to be attractive and help people get into homes. So that's going to be their mission. Who are they? Virginia Housing, the VHDA stands for Virginia Housing Development Authority. They were founded in 1972 and established by the Virginia General Assembly. Self-supporting and no taxes or funded by the federal or state subsidies, which means it's not taxpayer funded. So self-supporting, they generate their income through the mortgage-backed securities that they buy and sell in the secondary market, and that way they can provide this financing for their first-time home buyers. What you're looking at is who is eligible for these type of programs. Well, the title, Virginia Housing Development Authority, tells you that it's the state of Virginia. Now, most other states have similar type of programs, but probably not as attractive as the Virginia Housing Development Authority. Since they've been established since 1972, they've really kind of honed the program and have made it very attractive for first-time home buyers. So the first thing is, how do they define a first-time home buyer? A lot of people will think, well, I've owned a home, it was about 4 or 5 years ago. Well, their definition is you haven't owned a home or haven't owned a portion of your principal residence in the last 3 years. So you could have purchased a property 5 years ago and has sold it 4 years ago, and you would be eligible as a first-time home buyer under this program. Now, just to give you an example, I've had people that, an example I can remember is brother and sister, where they bought an investment property together and they were still living in their parents' house. And the brother wanted to go out and buy a house, and we were able to get him under this program because the house that he owned with his sister was an investment property and not his primary residence. So they were able to use this program and take advantage of the first-time homebuyer programs that VHDA offers. So U.S. citizens, permanent resident aliens, that's somebody who has a green card, and non-permanent residents that have a valid social security number and are eligible to work in the United States. So EAD stands for Employment Authorized Documents. So it's usually a card that they have, and that will be accepted under most circumstances. So what type of properties are eligible? Well, what they do have is they do have a sales price restriction. We'll go into that in another slide, but pretty much single family detaches, townhouses, and condos. So we're pretty standard properties that we're looking at that will fit into the VHDA program. So for the Washington, D.C. area, and that's most of all of Northern Virginia, the maximum income limits, so under these programs they do have income limits, so they define it by the number of people in the family. 2 or fewer people in the family is 125,700, and for 3 or more it's 146,700. And so down below that you'll see the 500,000 sales price limit. That is for new and existing properties. So that is going to be a restriction that somebody that is looking to buy, say, a $550,000 house would not be able to get under the VHDA program. So the changes that they've made are under 3 programs or 3 categories. 2 broad categories, the FHA and then also the conventional. We'll first talk about the FHA program. They used to have what they call the FHA, VHDA FHA Plus program. And they changed the title to it and they just call it the FHA with a second trust. And what they're doing is they're combining the standard FHA program, that's 3.5% down payment, with a second trust. And that second trust is at 3.5%. So it allows the purchaser to get into the home with little or no investment on the property. And we're going to show you how you can structure that so the borrower can get in actually less than he would paying trying to get into a rental. We'll allow the seller to pay up to 6% of the closing costs and prepaids. So the second trust, that 3.5% down payment that they're providing through a second trust, is at the same rate and term as the first trust. Now that's very unusual. Most of the time when a second trust is being combined with a first trust, the interest rate is going to be considerably higher, and then you're going to see usually a shorter term, maybe 10 or 15 years. What VHDA has done is they will allow that second trust to be at the same rate as the first trust. So if you got a 4 3/4, then your second trust is going to be at 4 3/4 and spread over the 30-year time frame. So makes the payment for that second trust very, very attractive. Now, if the person qualifies, they'll increase that second trust an additional 1.5% to help pay some of the closing costs in the case that you run into that the seller is not going to pay all of the closing costs. So it's helping them to still get into that property with a small amount of money out of pocket. Because what we see is that people that qualify for this program have, good jobs, they have the income to be able to qualify, but they're struggling with the down payment. So these programs are going to help them to get in with a small amount of money out of their pocket. So the maximum of the second trust under this program would be 5%. And like I said, that additional 1.5% over the 3.5% down payment can be used for closing costs and prepaids. Some of the unique things about this now is that there's no tax returns required. Used to be VHDA, under these programs, you had to provide the last 3 years' tax returns. And that's where they determined if you were a first-time home buyer. Now they have other ways of doing that. They had some background checks that they use called like Data Verify. They also verify it with the credit reports, and then the borrower will sign an affidavit saying that they haven't owned a portion of the principal residence in the last 3 years. So also, when we get tax returns from a borrower, we're required to verify those with tax transcripts from the IRS. Well, under this program, we no longer have to do that. So that speeds up the process a little bit and just makes it a little bit easier for the borrower as far as paperwork is concerned. Now, the next line down there says, can split incomes. What VHDA used to do on all their programs is that maximum income limit that we were talking about, they would look at everybody in the family that was generating income through a job, and even if you were generating it through Social Security or anything like that, they would look at total family income. Well, what they'll do now is they'll allow you to split the income. So say if we had a situation where you had a husband and wife and they were both making, say, $70,000, that would put them over the limit. Well, if they would qualify on just one income, what we could do is take one of those people out of the equation and just have one person buy them, say the wife buying the house, just using her 70,000, then they would still qualify with that maximum income limit. So it wouldn't be pushing them over because we wouldn't have to count the husband's income on that. 1% reserves. Now, under these programs, it used to be that you had to have a 1% reserve. Now, you're not using that, but you had to show that you had 1% of the sales price in reserve somewhere, and it had to be your own funds. Now they're allowing that to be a gift. So that's a big change also. So with those changes, they've made this program a lot more flexible, and they're allowing a lot more people now to use this program based on these guidelines, which will get a lot more people into homes. Now, a new program that they have is the one with the FNMA, that's standard for Fannie Mae, with the second trust. So several years ago, they came out with a conventional loan with 3% down, but it always required a 3% down payment. What they've done recently is change that program. It's 3% down, and now they're going to allow you to combine that with the second trust at 3%. So again, with the 3% or the 97% loan and a 3% down payment, you have 100% financing on the property. Now, this is considered a Fannie Mae loan or a conventional loan. So there's some of the guidelines you have to go with VHDA, and then also have to combine it with the Fannie Mae guidelines. So on the Fannie Mae, they will only allow the seller to pay up to 3% of the closing costs. So that usually will take care of most all the closing costs in this area. It would be pretty much all the closing costs, usually construction where all the closing costs will be covered under those 3%. So under the conventional now, they have two main programs. One is the zero down payment with no PMI, private mortgage insurance, and the other one is the no down payment with reduced PMI. So we'll go into the specifics on those individual programs on the next slide, but the second trust now, well, if they can qualify, in other words, the qualification is generally speaking with higher credit scores, they'll add another 1.5% to that second trust, making it a 4.5% when you're using the conventional, to allow the borrower to use that to pay some of the closing costs or prepaids, assuming the seller is not going to pay those. They can't use that money to get it back, but they can use it to pay costs that they need. Under this program, again, no tax returns are required, but because it's a Fannie Mae program, they do require a minimum of 2-year tax transcripts from the IRS. So that is something that we do have to get under the conventional program. They will allow us to split the incomes again, so making this program very, very attractive. And again, the 1% reserves can be a gift. So they're trying to make these changes to make it very attractive to get first-time home buyers into homes. So what we've done here is provide some examples of how the financing would work. And in this first one, if the sales price was, say, $300,000, and we're looking at an FHA with the second trust, assuming the credit scores are under 680. First trust base loan amount, now that's going to be the sales price minus the 3.5% down payment. Then you see the total loan amount is a little bit higher than the base loan amount. What what FHA does is they charge an upfront MIP, or mortgage insurance premium. So they take the base loan amount, and at this point it's 1.75%. So they multiply the base loan amount times 1.75% and add that to the base loan amount, which gives you the total loan amount. Then you see that the 3.5%, $10,500, so the down payment is 0. Estimated closing costs about $7,200. The prepaids about $1,800, and then if that adds up to $9,000, we get a seller's credit of $9,000. So the borrower's investment buying this $300,000 house actually can come out to be zero. Now, a lot of times, the purchaser will be paying for, like, say, a credit report up front or a home inspection, but if it's structured correctly, they can get reimbursed for those when they go to closing. The second example is going to be the FHA with the second trust when the credit scores are above 680, and VHDA is providing 5% on the second trust, so an additional 1.5%. Under this example, the sales price is going to be $400,000. Again, your base loan amount, $386,000, and then the total loan amount, where they're adding that 1.75 MIP on top, you come out to a total loan amount of $392,755. The second trust, that 5% of the $400,000 is $20,000. So the down payment then that you're looking at would be $14,000, which is going to come out of that second trust. Under this example, the estimated closing costs on prepaids are $12,000. So the remainder of that second trust, the $6,000 that is left over from the $20,000 when you subtract the $14,000, you're using that to pay some of the closing costs, and then seller's credit of $6,000. Again, you're getting the borrower into the property with zero money out of pocket. So a very attractive program. Now, the next slide is showing you a similar example, but we're using the Fannie Mae, or the 3% down with the second trust, when the scores are under 680, and they're only allowing the second trust to be that 3%. So the sales price is $300,000, subtracting 3%, the base loan amount of $291,000. Now, the conventional doesn't have an upfront MIP or PMI, so the total loan amount and the base loan amount are going to be the same. The second trust is $9,000, so the down payment that the borrower is going to be coming up with is going to be zero. Your estimated closing costs, $7,200, prepaids, $1,800, and then the seller credit, $9,000. The borrower, again, is getting, under this example, in with zero money out of pocket. The next example we're seeing is credit scores above 680 using the Fannie Mae with the second trust. So they're still, under this example, putting the 3% down. So the sales price of $400,000. The first trust loan amount is $388,000, and I just noticed it says FHA first trust-based loan amount, and that's a conventional. So, but there's no total loan amount. So it's just a $400,000 minus the $300,000, with a down payment being $12,000. So what they're doing then is taking the $12,000 in prepaids and then taking the additional that they're coming out, the 1.5%, that's $6,000, and using that remainder from the second trust to pay a part of that closing cost, and then with the seller credit of $6,000, the borrower investment again comes out to $0 out of pocket. So this next slide, I wanted to give you an example of how it looks like on a monthly payment. Now, we're not including the second trust in there. I just wanted to give the example of the first trust and what the difference in the monthly payment would be with the different programs. You'll see that the FHA is a lower interest rate than the conventional with the reduced MI and the conventional with the no MI. But because the FHA has mortgage insurance included in there, the MI, you see that $136,071. The total $1,371.36. Now, the conventional with the reduced MI, you see that the interest rate is a little bit higher. So what they're doing is, this is a standard MI, but because it's under the VHDA program, they've structured a deal with the PMI companies to offer reduced private mortgage insurance, or MI, that will make it a little bit more attractive when using the conventional program. So you can see that the MI is only $98.62. So this makes the total payment a little bit cheaper than what you're looking at as far as the FHA, even though the interest rate is higher, $1,350.28. And then the conventional with the no MI. So basically what they're doing is they're increasing the rate. You can see it's 5.5%. So considerably higher than the FHA. So they're building the MI into the interest rate. is what they're doing. So you can see that the principal and interest is going to be higher, but because there's no MI payment, you're seeing that the total payment is actually coming out cheaper on all three of those. So depending on the individual and how long they're planning on owning the property would determine which program we would go for. Some of the programs have a little bit more flexibility in certain areas, so we might guide a person more toward an FHA. It might be more advantageous for them as opposed to conventional, and some people, we might go with the conventional loan program. So it just depends on each person and each person's individual situation that we would take a look at. That is the end of our course that we're talking about today as far as the VHDA new programs that have just come out recently. We're going to be doing some more seminars, but if you have more additional information or if you'd like more additional information, you can always contact cindybishopworldwide.com, or you can contact me. My contact information was on the first or second slide, and I've been in mortgage banking a long time. Would be more than glad to help you out. Other than that, you all have a great day. Thanks, Al. Bye-bye.